could even do a live Q&A. Who knows? The possibilities are wild. There's a little bit of jazzy Spanish going on there outside.
Hi guys, thank you so much for joining me in another video. In this video, I will talk about a little habit that when done consistently will give your children the best start to their adult life. And that is by using a JISA. So that's a Junior Investment Savings Account, a Junior ISA. Hi, I'm Fifi. I'm a mom, engineer, a consultant living in London, and I make videos about saving money, investing, and understanding the economy to make better financial decisions. Now, we all know that being a young adult is expensive. I've been there, and if you'd believe, my younger sister has just turned 16 and she's about to embark on that journey herself, all too aware of so many of the comforts we want in our future that cost significant chunks of money. So the most usual areas of angst is student debt and saving for a deposit, and already the bank of mum and dad step in to help the children. According to statistics, nearly 80% of people who don't own a property want one, and 3/4 feel like they're priced out. Just sprinkling a few facts out there, guys. And that's where the bank of mum and dad step in and are now the 10th largest lender to aspiring home owners. That's a little bit scary, right? Now, there are mechanisms right now that would help set your children up for better entry into the adult life. The probability is that they will have these elements in the future, and some smart planning right now from a parent's perspective could make things a lot simpler. And yes, I'm going to talk about the boring part of personal finance, which is long-term consistency, but it has to be done for your kids. Now, the easiest way to do this right now is using a JISA. So that's a Junior Investment Savings Account that we have in the UK. And the allowance is a whopping 9k a year now. JISAs actually replace the old child trust fund accounts that were around in 2011. Now, while there is no tax rebate for investing on behalf of your children, the tax advantages are quite considerable and build over their life. If you do have the old child trust fund, it can be switched over to a JISA, with the main advantage being the ease and flexibility to invest in cash and investment products. So like I said, the JISA, £9,000 allowance per year for your child maximum. It matures when the child turns 18, at which point it converts to an ISA and is accessible for your child. Heaven forbid my girls go and blow their entire ISA on a big 18th birthday party. But hey, the allowance is quite hefty. It's 9k per tax year, and that equates to about £750 per month if you want to kind of max out each year with a large chunk of change. Jokes aside though, it is quite a large amount, and there is a real risk that your child having that much capital on their 18th birthday is dangerous, okay? I mean, think back to your own 18-year-old self. If you're my age, if I had a chunk of change that big on my 18th birthday, who knows? And then even thinking about my husband, boy, gosh, let's not go there. So that being said, if we are parents looking at these products, then clearly we have an interest in investing and will impart our knowledge to our little ones, give them that financial education and power of consistent investing from an early age, right? Now, when I'm talking about investing with other mums and people that aren't that familiar with the stock market and how funds work, etc., the most difficult aspect people get muddled up in is what to invest in. So you've opened your JISA, you've opened your account, now what do I buy? Like, it's all confusing, and that's where the main roadblock is. I have found that this is the most daunting thing when speaking to friends and other mums and just people generally about when they're investing for their children. And we need to put ourselves in the shoes of the ISA owner. So that, in this case, is our child. So if we open the ISA from the moment they're born, that is almost 2 decades of investing, guys. And that's long enough to ride out any economic cycles. Likewise, conventional wisdom states that the younger we are, the more we can allocate to equities. So we should feel confident about investing in equities on behalf of our children, okay? And the key word is behalf there. However, the majority of people do tend to mess this up and hold about 70% in cash for up to 18 years to erode away with inflation, and that just doesn't make sense. Cash is simply not a good home when you're thinking about giving a child a head start in life. Even if you get a cracking rate right now, it isn't comparable to what you would get if you invest in the market. So let's work through it. Investing cash at 3% return and topping out your allowance each year would grow to something like £214,000 with a total investment of £162,000. 44,000. So it's not bad. Now let's say you invest a modest 75 a month, then you would have 21k on total deposits of 16.2k. And that's not bad either. However, let's assume you have been able to generate the average stock market return of the S&P 500, which has historical returns of about 9.8% as an example. Again, some calculations, if you put in a modest £75 a month, your deposits would total to 16.2k, but the investment value for your child would be £44,000. That's more than double. Now for the big one, if you topped out your child's ISA £750 a month for maxing out the 9k allowance every year, are you sitting down for this one? On those rates of return, you could be looking at £440,000 by the time your child turns 18. Ding-a-ling-a-ling-a-ling. Now that is insane. I always want to talk about my quick tips, and that is invest consistently instead of timing the market. So you are investing on behalf of your child. Don't try to be a trader. Consistency will also allow dollar cost average to work its magic and get you closer to the historic rate of return. And the second tip is, if someone turns around and tells you that you're never going to get that much money through the markets, tell them to just go off on their way down boring alley. Okay, don't listen. Finally, what do? Well, I like Vanguard, so you don't have to use them. There are other platforms like Fidelity, Hargreaves Lansdown and all of those, but use a reputable broker for your child. So if you'd like me to cover this part in a little bit more detail, let me know down there in the comments below and I'll do a quick video on it. Or I could even do a live Q&A. Who knows? The possibilities are wild. So I put together a collection of videos on the basics of investing for the long term, which covers inflation, compounding and dollar cost averaging. So you're familiar with how this type of investing strategy is robust for the long-term investor. So click down there to have a look. But until next time, I'm out. Cheers, guys.